If you're into overlooked income plays, you might want to pay attention. At Insightful Value, we dig through the noise and spotlight the stocks nobody's talking about. Yet, one of them, Nomura Real Estate Master Fund, trading at unusually low levels despite solid fundamentals. This video is for informational and educational purposes only, not financial advice. So, what's the story behind Nomura Real Estate Master Fund, also known as NMF? It's a Japan-based real estate investment trust, or J-REIT, with a heavy focus on premium office buildings, retail centers, logistics hubs, and some residential properties. Essentially, it's a diversified play on the Japanese commercial property market, backed by a serious management team and strong underlying assets. As of 2025, the fund manages over 260 properties and roughly 1.2 trillion yen in assets. Despite this scale, the stock trades at a significant discount to NAV, a common trend across Japanese REITs, but one that's especially sharp for NMF. The trust has been hit by soft sentiment in Japan's office space market, plus macro fears around deflation, aging demographics, and limited GDP growth. But the truth? Many of those risks are already priced in. NMF has posted relatively stable earnings over the past few quarters. Operating income margins remain above 40%, which is strong for a REIT, and occupancy rates across their portfolio consistently hover around 98%. Cash flow is steady, and they've managed to maintain their payout. Speaking of dividends, the real reason some investors look into REITs, Nomura has continued distributing dividends twice a year, and the current yield is sitting above 5%. That's especially attractive in Japan's low-interest environment. They've grown dividends slowly over the past few years, and while it's not explosive growth, it's been dependable. So why is the stock still lagging? Well, market sentiment hasn't been kind to office-heavy REITs. Concerns about hybrid work and corporate downsizing in urban Tokyo have spooked investors. But here's what's overlooked. NMF has been actively rebalancing its portfolio, adding more logistics and residential properties while offloading lower-performing retail spaces. That diversification could stabilize long-term income. They've also kept a conservative balance sheet, with a low LTV, loan-to-value ratio of around 42%, and most debt is fixed rate, which limits risk from potential interest rate fluctuations. The downside? Japan's real estate market isn't exactly booming, rental growth is modest, and economic headwinds persist. Foreign investors may also shy away from J-REITs due to currency risk, especially with the yen's recent volatility. Still, for long-term income seekers, especially those looking to diversify geographically, NMF could be worth watching. At Insightful Value, we specialize in breaking down under-the-radar stocks like this. We go deep into the data, cut through the jargon, and help you understand where value may be hiding. If you want more analysis like this, check out insightfulvalue.com. We cover undervalued companies and misunderstood sectors, giving you tools to invest smarter. If you found this video helpful, give us a like, hit that subscribe button, and don't forget to visit insightfulvalue.com for more deep dives into hidden investment ideas.